Greetings to Dr. Basha. So today me and my team members are going to present about Maxis BERHAD, DIGI BERHAD and ASTRO Holdings BERHAD, which is telecommunication and media company. Now I'm going to introduce you my team members, where myself is Divesh, Lukman, Bhuvaneswari, Dinesh and lastly Yaga.
Return on equity is ROE is a key financial metric that measures the company profitability of a company in relation to its shareholder equity. It indicates how effectively a company is utilizing its equity to generate the profit. So our first company is Maxis BERHAD. In 2020, Maxis recorded an ROE of 19.60%, which is decreased slightly to 19.45% in 2021. However, in 2022, there was a further decrease to 18.54%. This indicates a slight decline in Maxis profitability over the years, as the measure by the ROE. So next company is DIGI BERHAD. DIGI experienced significant fluctuation in the ROE over the analyzed period. In 2020, its ROE was expectedly high at 201.53%, indicating strong profitability relative to shareholders' equity. However, in 2021, the ROE dropped drastically to 183%, and then by 2022 it further declined to 4.68%, suggesting the substantial decrease in profitability. So next company is ASTRO Holding BERHAD. ASTRO demonstrated as a consistent trend of ROE over the 3 years. In 2020, its ROE stood at 75.32%, which is decreased to 48.97% in 2021. However, in 2022, there was a significant decrease to 40.58%. Despite the fluctuation, ASTRO maintained relatively strong profitability compared to its shareholder equity. Strength for the ROE is a return on equity, potentially leading to increase the investment in the company and can utilize the ratio to access the management performance. And then the weakness for ROE can vary based on the company's capital structure and industry, and then potentially enhance this ratio by reducing the equity through share buybacks. And then this is the short run or long run. In this situation, Maxis is the highest return on the equity, which decreasing 47% from the 2020, which means 19.60%, and 2021 shows 19.45%, and then 2022 19.60%. Hence, it is a good for the long term.
So for this slide, the highest I'm going to talk about return on assets, and the highest return on assets in Maxis is on year 2020, which is 6.30%. Then for DG will be in year 2020, which is 14.91%, and for the last company is ASTRO, and the highest percentage will be in year 2020. Other than that, the strength for return on assets can be used by management, analysts, and investors to assess whether a company utilizes its asset efficiently to generate profit. Return on assets is a financial metric that indicates a company's profitability in relation to its total assets. Now we going to the weakness, where the ROA formula is most applicable to banks and financial institutions, as it specifically measures how effectively they generate profits from their assets. ROA can be used universally across industry because companies in different industries have varying assets bases. Furthermore, for the short run or long run, the return on assets ratio measures how effectively a company can convert the money used to purchase assets into net income or profit. ROA on the higher side is considered more efficient. The ratio shows that DG has a higher return on assets, but decreases from 2020 to 2022. It is better for the long term or long run.
Operating profit margin is the ratio of operating income to net sales. The operating profit margin for Maxis, DIGI and ASTRO is decreasing every year from 2020 to 2022. These figures still indicate relatively healthy profitability from operations. If the operating profit margin is low, it is an indicator that operating costs are too high. Resulting metric is low, it is an indicator that profitability is too low. The strength of operating profit margin is expressed on a per sale basis after deducting variable costs but before interest of tax, which is EBIT. The operating profit margin reflects the efficiency with which a company generates profit from its core operation. The weakness of operating profit margin is different industry with their widely varying business models often exhibit significantly different operating margins, and the operating margin is most effectively used for comparing companies within the same industry, particularly those with similar business models. Operating profit margin on the higher side is considered more efficient. It is good for the short term. The gross profit margin ratio is the profitability ratio that measures how profitable a company can sell its inventory. The gross profit margin for Maxis, DIGI and ASTRO is declining every year from 2020 to 2022. These figures indicates that company was able to maintain a positive difference between revenue and cost of goods sold. The strength of gross profit margin it serves a guideline for companies in adjusting price to maximize profit, and it's a simple and effective indicator. The gross profit margin is easy to calculate and provide insights into a company's cost efficiency, financial health and direct cost performance over a specific period. The weakness of gross profit margin may not always serve an ideal benchmark for industry comparison due to variation in cost structures and profit determinations across different industry, and it does not provide a complete picture of company's operational efficiency because it is exclude indirect costs such as salaries, rent and advertising expenses. Gross profit margin on the higher considered more efficient, therefore it is better for total revenue and good for short term.
Total asset turnover. For Maxis, the turnover was best in year 2022 at 0.42. For DIGI, it was best in the year 2021 as 0.81, and ASTRO was best in the year 2020 as 0.79. Strength. To compare one company to another before making a decision indicate that the company assets are no longer able to generate income. Weakness. High sales compared to its available asset does not necessarily mean that they are generating a profit. Can't compare in various industries. Short run or long run. Therefore, it is better to use Maxis coverage, best for the long term.
The total liabilities to the equity ratio measure the proportion of a company total liability relative to its shareholders' equity. It indicates the extent to the company. A company is financed by the debt and then compare it to the equity. So the first company is Maxis BERHAD. In 2020, Maxis had the total liability to equity ratio of 2.16, which increased to 2.34 in 2021 and further to 2.62 in 2022. This indicates a gradual increase in Maxis reliance and the debt financing relative to its equity over the years. And then the next company is DIGI BERHAD. DIGI exhibited significant fluctuation and its total liability to equity ratio over the analyzed period. In 2020, The ratio was 12.51, suggesting a high level of debt compared to the equity. However, in 2021, there was a substantial decrease to 11.39, indicating a reducing in debt relative to equity. By 2022, the ratio further decreased to 1.30, significant a much lower reliance on the debt financing compared to the equity. And then our last company is ASTRO Holding BERHAD. ASTRO's total liability to equity ratio also demonstrated an fluctuation over the 3 years. In 2020, the ratio stood 5.60, indicating a relatively high level of debt compared to the equity. By 2021, there was a slight decrease to 4.04, suggesting a reducing in debt relative to equity. However, in 2022, the ratio increased to 3.42, indicating a slight uptick to the company's reliance on the debt financing compared to the equity. The strength of total liability to equity ratio are capital structure. To compare one company to another before making a decision, and then financial analysis to evaluate a company's financial leverage, and then the weakness are an ideal ratio is not update and maintaining their asset through debt financing. And the second one is investor can be mislead to examine the company from every viewpoint and prohibit all of its components. And then it is a short run or long run. In this situation, Maxis is more stable in their business because lower in total liabilities to equities than ratio and DIGI. Got a high in their total liability and equity.
Ahmad Manuel Hakim. I'm going to present to you about price to earning ratio. Okay, so firstly, I'm going to talk about Maxis. So Maxis PE ratio was declined over the past 3 years. So the PE ratio was decreased in the following years, suggesting that the stock price growth might have been slowed down. So next, for DIGI. So DIGI PE ratio remained relatively stable over the past 3 years. So with value ranging from 3.60 to 4.41. Okay, and lastly is ASTRO. So ASTRO PE ratio fluctuate over the past 3 years. So the PE ratio was relatively high, indicating the stock was priced at premium compared to its earning. However, in 2021, the PE ratio was dropped significantly to 0.96, which might indicate an undervaluation. So next, I want to talk about the strength and the weakness and the short run or long run. Okay, first, I want to talk about the strength first. The first point is enable the comparison of the performance of stocks. Second, allow the monitoring of a company's stocks performance. The weakness is comparison should be limited to the companies. Second, could be deceptive if there are extraordinary gains or losses. Okay, so for the short run or long run. So in this situation, ASTRO has the lowest PTE with only 0.47% in 2020. 0.30% in 2021 and 0.19% in 2022 compared to these peers. Therefore, it is better for the business and potential investor, best for the short term. Okay, so we move to the next ratio. The next ratio is price to book. Okay, so for the DIGI PB ratio has been fluctuated significantly over the past 3 years. In 2021, the PB ratio scored to 4.38, indicating that the stock market price was substantially higher than its book value per share. And then Maxis. So Maxis PB ratio, like DIGI, experienced a significant increase in 2021. So the PB ratio of 4.04 indicate that the stock market price was considerably higher than the book value per share. And lastly, about ASTRO PB ratio was also been fluctuating over the past 3 years, but overall it has remained relatively low. So ASTRO PB ratio below 1 indicate that the stock market price is lower than its book value per share. Okay, next I want to talk about the strength and weaknesses of the price to book ratio. Okay, so the firstly is price to book ratio is a simple way to see how much the company is valued in relation to its net worth. It is more stable since asset priceless are less variable than earning, and it can also be used to value business that have not yet turned in profit. Okay, so for the weakness, price to book ratio is only helpful in the practice when applied to the capital intensive organization such as energy, transportation companies, huge manufacturing and financial corporation. So, the intangible asset such as company brand name, goodwill, patents and other intellectual property are not included in the book. It does not carry any information for service-based businesses. This has a lot of significance with a lack of tangible asset. Long run, short run. So, if the market book ratio is less than 1, on the other hand, the company's stock price is selling for less of the asset actually worth. In this situation, ASTRO, DIGI and Maxis does not have a good PTB. Not good for the short term.
Dividend payout. For Maxis, the dividend payout ratio was best in 2022 as 33.33. For DIGI, it was best in year 2021 as 0.56. As per ASTRO, it was best in the year 2022 as 0.66. Strength. For evaluating the operational performance of a business and assessing its growth, focused on creating value for shareholders, demonstrating maturity. Weakness. Maybe plowing back its profit for future expansion or growth, analyzing on the company before blindly believing. Short run or long run. In this situation, Maxis looks more efficient in paying dividends, but the ratio increased from 2020 as 1.83%, 2021 as 1.13% to 2021 33.33%. Therefore, it is a better sign of a strong balance sheet, best for the short term.
Thank you.
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 Thank you.